So guys, in this video, I'm going to be answering some of the really great questions that I've been getting from all of you lately, starting with this one here from Valmir King, who wants to know, when do you think that you can start living off your dividends? How much do you need? And man, this is the $1 million question. We can actually use this dividend reinvestment calculator here, which I'll link for you guys in the description, to see what my portfolio could look like in the future. And based on my current portfolio value of around $84,800, my weekly contributions of $250, and estimated returns, a 3.5% starting dividend yield. We'll use a 7% dividend growth rate and a 7% share price appreciation. With these inputs, I could end up with a near $1.4 million portfolio 20 years from now. And my dividends in that 20th year could be around $40,000, which breaks down to around $3,300 per month. Now, that's not too bad. And at that point, I could do things to increase my portfolio's yield if need be. We'll just have to see where things end up. And with that said, I may actually start pulling my dividends a bit sooner than 20 years from now. At least for now, my plan is to start using some of my dividends to cover my expenses once I reach a point where my portfolio is generating around $2,000 per month on average. Maybe I'll use half of my dividends to start paying some of my bills, and then I'll just continue reinvesting the other half. I think that would be a good way to reward myself for all of that hard work over those number of years. But we'll see what happens. That's kind of what I'm thinking right now, but my mind could totally change. Now, with the numbers I'm using, it looks like it'll take around 15 or 16 years, somewhere in there, to reach that $2,000 monthly milestone. And what's crazy is that between years 15 and 20, just within 5 years, my annual dividend income skyrockets. It goes from, $23,000 to over $40,000 in no time at all. And that is the power of the dividend snowball effect. But anyway, now moving on to question number 2. This one comes from Johnny, who wants to know, do you ever feel like you are limiting yourself by only investing in dividend stocks, especially when you're missing out on amazing returns from companies like Sofi and Palantir recently? Now, this is a fantastic question, and to be honest, I don't feel like I'm missing out at all. My portfolio is actually having one of my best years yet. In fact, since I started posting videos here on YouTube, which would have been October 15th, 2020, that's when I posted my very first video here, my dividend portfolio between then and now has actually outperformed the S&P 500. Of course, that could change down the road, but so far things are looking great. And with that said, I think this question gets to a common myth about dividend stocks, which is the belief that buying dividend stocks somehow locks you into a life of subpar returns. Now, obviously, it depends on which companies you invest in, but that's true no matter what, whether the company pays a dividend or not. And there are plenty of dividend-paying companies out there delivering very strong returns. For example, if we just take a look at my holdings here on my dividend portfolio tracking spreadsheet, which you can start using for free, there is a link to download this spreadsheet in the description of the video. But here we can see that I have quite a few holdings that have done pretty stinking well. I mean, AbbVie is up over 63%, Altria Group is up over 60%, Snap-on, which has absolutely crushed it this year, is up almost 80%, and Williams-Sonoma, which is my best performing position, is up over 100%. And obviously companies like Palantir have done pretty well recently, but like I said, I'm totally fine not owning them. I could be wrong about this, but I have a suspicion that, at least at this stage of the game, many of the people who are starting to invest in those types of companies are just chasing the hype and are trying to ride this wave of positive momentum that those companies are currently seeing. Those are very trendy stocks right now, and trying to hop on the bandwagon because everyone else is doing it or everyone is talking about it is just not a strategy I particularly care to partake in. At the end of the day, I'm not too worried about missing out on whatever the hot stock of the moment is. Palantir and Sofi are certainly having their moment right now, but at some point, and I'm sure at some point soon, there will be another stock that will come to replace them. And that is a cycle that will just continue to go on forever. With that said, though, as Russ would say, there is more than one way to get to financial heaven. And so I hope that Palantir and Sofi and whatever other stocks that are kind of along those lines turn out to be massive money makers for whoever invests in them. But anyway, guys, this brings us to our third question of the day. This one comes from Matthew, who wants to know, is there a simple formula for retirement investing? For example, if I'm investing over a 15-year horizon, should I target stocks with a specific yield and growth CAGR? And how would those targets change for different timelines, like 10, 15, or 20 years? And this is another really great question. I mean, while there's no perfect formula, there are some useful rules of thumb you can follow. In general, the farther that you are from retirement, the more that you may benefit from investing in stocks with high dividend growth CAGRs. Think of companies like Visa or Microsoft or Rollins or Snap-on that may have these, low starting yields that are really not that exciting at first, but they have these dividend growth rates that are well into the double digits. The idea here with these types of stocks is that with more time to let these companies grow and compound, your yield on cost at the time of retirement, especially if we're talking 15, 20, 25 years, it could outpace what you'd get from investing in higher yield, lower growth stocks. Now, on the other side of that, as you approach retirement, there's less time for the dividend snowball to grow and compound. At this point, your income needs are a bit more immediate than if you had 15, 20, 25 years left until retirement. And so in that case, it could make sense to shift more into higher yielding stocks. Now, with that said, this is not a pass to buy yield traps. That's never a good idea, okay? I don't care how high the yield is. You still want to invest in companies that have a history of making consistent dividend payments. Now, some examples of these might include stocks like Realty Income, Main Street Capital Corporation, or even Altria Group, which have high starting yields and still offer these steady dividends, even though they may not grow as quickly. Now, personally, I like to keep a balance of both types of dividend stocks in my portfolio. The high yield, low growth stocks, along with some low yield, high growth stocks. I feel that it gives me the best of both worlds and offers both an adequate yield today with solid dividend growth over time. Now, with that said, if you want to see how different yield and growth profiles might play out, you can use that free calculator that we saw earlier in the video to project your portfolio's future growth. And once again, I'll have that linked in the description. But anyway, guys, now moving on to our fourth question of the day. And I think this one is one of the most important ones. This one comes from Jacob, who says, how are you able to choose the slow and steady process of dividend investing instead of a more exciting approach like day trading, options, or something more along those lines? Now, guys, Jacob and I exchanged a couple of emails back and forth on this topic, and from our conversation, I got the sense that Jacob was going through something that I think a lot of us investors go through, and that's the temptation to seek out fast results and overnight returns. He even mentioned that he was trying options and trading penny stocks. And he said that, he's really feeling this heavy gravitational pull toward chasing quick gains, even though, he knows it probably isn't the right thing, but he's still feeling that. And I think what Jacob's going through gets to the heart of one of the hardest parts of investing, and that is just being patient. In psychology, there's a term for this called temporal discounting, which is basically when you opt for immediate satisfaction over delaying gratification. This is what makes spending your money now on something fun, like a new electric bike, so much more satisfying than putting it into stocks and stashing it away for your future. And I'll tell you guys what, I want one of those bikes so bad. I've been researching them nonstop lately. I think it'd be the perfect way to just travel around my little neighborhood and save gas, but I just don't know if I can justify spending money on that right now. But if I were to pull the trigger on something like that, I'd get this immediate rush. And that same urge and chasing that rush is what makes many investors get into something like day trading instead of something like dividend investing. With dividend investing, the payoff is delayed by years or even decades, which can make it hard to put yourself in the shoes of a future version of yourself who will benefit from delaying gratification today. And while I completely understand wanting things to happen right here and right now, making decisions today for 20 to 30 years down the road is what's really going to build lasting wealth. And it's a lot less risky than trying to make things go to the moon by tomorrow. And this isn't exclusive to investing either. This idea of delaying gratification is the golden rule for really anything whose benefits only come with time. Things like working out or eating healthy or reading a book instead of scrolling TikTok. Every time you choose these more challenging, future-focused activities, you're forgoing temporary fulfillment today in exchange for something more meaningful down the road. Or in other words, you're sacrificing today for the betterment of tomorrow. And for me, chasing delayed gratification and developing this long-term mindset started long before I got into investing. I've talked about this probably way too many times for your guys' liking, but outside of investing in dividend stocks, I'm really into health and fitness, and I've been lifting weights consistently now for coming up on 14 years. And when it comes to building strength and putting on muscle, just like with investing, you don't see results overnight. You don't walk into the gym one day and just start benching 225, and you don't walk out with a six-pack after day one. Instead, you have to keep showing up, keep working hard, and continue paying your dues day after day, month after month, year after year. Coming into investing, having understood that, I think made it easier for me to accept that this is a long-term game, and this is going to take quite a long time to really slowly build up, as it should. But the great thing about dividend investing is that it's one of those things that just gets better the longer you do it. And there are plenty of small victories along the way that will help keep you motivated. Whether it's hitting a new all-time high in your portfolio or having a record month of dividend income, all of these things are worth celebrating. And guys, I know that dividend investing starts off slow, and I know it's kind of a hard thing to get excited about at first. But at some point, and it will happen sooner than you think, your dividend snowball will really start to pick up some speed and it will really start to take off. And that's what I'm telling you about in this next video right over here. I'm going to share with you where this point is, when I feel like it happened for me, and what it's going to take to reach this point in your investing journey. So click right over here to learn all about it, and I'll see you in the next one.